U.S. has imposed tariffs on imports of 1 kilo gold bars, dealing a further blow to Switzerland, which is the biggest player in gold refining.
43 metric tons of gold flooded into America in January 2025 alone, nearly double what U.S. refineries typically produce in a month. Traders were scrambling, loading up warehouses from New York to Chicago, desperately trying to beat what everyone in the industry feared was coming. Then, on August 9th, it happened. A single letter from U.S. Customs changed everything. Switzerland, the country that refines 70% of the world's gold, suddenly faced a 39% tariff on every bar shipped to America. Within hours, the global gold market froze. Not a single kilogram moved between Europe and the United States. Prices in New York shot above European levels, creating the kind of arbitrage gap that should be impossible in modern markets. Swiss refineries, which had spent decades building relationships with American banks and investors, shut down their shipping operations overnight. The message from Washington was crystal clear. No commodity, no matter how fundamental to global finance, was safe from the tariff hammer. The only thing I can tell you from a European perspective right now is that all shipments are on hold. A senior trader at one of Switzerland's largest refineries told industry contacts that morning, "There's no trading of gold bars across the Atlantic." This wasn't supposed to happen. Gold bars, whether the 400-ounce BRICS central banks hoard, the 100-ounce COMEX standard, or the 1-kilogram bars Asian markets prefer, had always moved freely. They were the lubricant of international finance, above politics, beyond trade wars. But that assumption died with Tariff Code 7108135550. The Swiss refiner's letter from U.S. Customs confirmed what nobody wanted to believe. Every gold bar entering America would face the full 39% duty. No exceptions, no negotiations. The immediate market reaction was brutal. Spot gold in New York climbed to $3,534 per troy ounce before President Trump reversed course just 2 days later, announcing on social media that gold imports would remain tariff-free. By then, the damage was done. Prices crashed, falling 2.5% in a single day to $3,404. For Canada, watching from across the border, this wasn't just market volatility. It was a warning shot. Prime Minister Mark Carney understood immediately what others missed. If gold could be weaponized, so could Canadian oil, minerals, and manufacturing. The same enforcement letter that paralyzed Swiss refineries could target Canadian nickel mines or Alberta's energy sector tomorrow. Ottawa had to act, and act fast. The gold shock came at the worst possible moment for Canada. On July 10th, Trump had announced 35% tariffs on Canadian imports, set to begin August 1st. Unlike Mexico, which received a 90-day delay, Canada got nothing. The message was unmistakable. America's northern neighbor would get no special treatment in this new trade war. Canadian exports plummeted 13% in the second quarter of 2025, with energy shipments down nearly 20%. Alberta's economy, already struggling with global oil price volatility, took the hardest hit. But Carney refused to panic. While Ontario Premier Doug Ford publicly challenged Trump's numbers and threatened retaliation, the Prime Minister quietly opened new channels. Finance Minister François-Philippe Champagne and Foreign Minister Anita Anand flew to Mexico City for emergency meetings with President Claudia Sheinbaum. The agenda was simple but urgent: build a united front before Trump could divide and conquer. "We have a lot to do in this country," Carney told reporters before the Mexico trip. "Building one Canadian economy. Donald Trump is very hard to deal with because it's so fluid." That fluidity, Trump's ability to shift targets without warning, made traditional trade negotiations impossible. The gold tariff proved that decades of established practice meant nothing if it conflicted with America's new economic nationalism. The human cost was already mounting on both sides of the border. In Detroit, auto suppliers started laying off workers as General Motors reported $1.1 billion in tariff-related losses for the second quarter alone. Ford followed with $800 million. Stanley Black & Decker projected $800 million in annual damage. Apple, anticipating the worst, budgeted $1.1 billion just for the current quarter. These weren't projections anymore. They were real losses, hitting real companies, employing real people. I went to India to procure products trying to save our consumers money, and now India is hit with tariffs, one Detroit supplier explained while announcing warehouse closures. Everywhere we turn, we're seeing more roadblocks. It's been quite discouraging. Walmart and Best Buy started passing costs directly to consumers. Shampoo, shoes, even coffee. Everything carried an invisible tariff tax. With America importing a third of its coffee from Brazil, another country now facing Trump's duties, economists warned that morning routines were about to get expensive. Canada's response revealed a fundamental difference in approach. While Trump wielded tariffs like a club, Carney chose precision over power. The 35% rate hit Canadian steel, aluminum, softwood lumber, and auto parts, sectors specifically chosen to maximize American leverage. But instead of matching escalation with escalation, Ottawa diversified. Mexico, despite accounting for just 1% of Canadian exports in 2024, suddenly became a priority partner. The timing mattered. With the USMCA review scheduled for 2026, both Canada and Mexico recognized that unity offered their only protection against Trump's preference for bilateral deals. Earlier tensions, when some Canadian leaders suggested cutting Mexico out of the agreement, evaporated in the face of shared pressure. Champaign and Annan's Mexico City meetings weren't just diplomatic courtesy, they were survival strategy. The European Union watched these North American tremors with growing alarm. Brussels had spent years building careful trade relationships, only to see them threatened by America's sudden pivot. When Trump floated 20% tariffs on European cars and industrial goods, EU officials scrambled to prepare countermeasures. But the gold incident exposed a deeper vulnerability. Europe's financial infrastructure depended on smooth commodity flows that tariffs could instantly disrupt. We're seeing the weaponization of trade policy in ways that would have been unthinkable just 5 years ago. A senior European central bank official confided to colleagues in Frankfurt. The concern wasn't just about gold or cars, it was about trust. If America could block Swiss gold refineries with a single customs letter, what else might be coming? China, observing from Beijing, drew its own conclusions. The 60% tariffs Trump imposed on Chinese goods were painful, but expected. What caught Chinese policymakers off guard was the collateral damage spreading through global supply chains. When Trump hit India, Vietnam, and Thailand with new duties, he wasn't just targeting those countries. He was closing escape routes Chinese manufacturers had used to bypass earlier tariffs. The numbers told the story. Chinese exports to America fell 28% in the first half of 2025, but exports to Vietnam rose 42% in the same period. The math was obvious. Chinese goods were simply taking detours through Southeast Asia. Trump's response was predictable and brutal. Any country showing unusual export growth to America faced immediate tariff threats. The message to Beijing was clear. There would be no hiding, no workarounds, no clever restructuring to avoid the pain. But pain works both ways. Apple's Tim Cook flew to Washington 3 times in as many months, warning that the $1.1 billion quarterly hit was just the beginning. We're not just talking about profit margins, Cook reportedly told administration officials. We're talking about the entire consumer electronics ecosystem. When iPhones assembled in India faced the same tariffs as those from China, Apple's decade-long diversification strategy